I see. Okay, let's welcome in Vineet Sambre, who's head of equities at DSP Investment Managers. Vineet, great to have you back on the program. Thanks very much. Prashant this side. Uh, have we, the general kind of comment has been that with bulk of earnings now with us for the first quarter, that it's been an inline kind of quarter. And that may be true, but what has that meant for earnings expectations for FY24, Vineet? I suspect we've got once again more downgrades to full year estimates as compared to upgrades. Would you agree? And what does that mean for markets from here?
So, Prashant, as far as the overall earnings momentum is concerned, and when we think about the current year, I would like to stick to my general thesis that what may look like happening this year would be, we'll have in a lot of the sectors margin expansion playing out. And that actually we are watching as far as the first quarter results are concerned. Even the fourth quarter to some extent reflected that happening. And my sense is that we will see this trend only sort of improving, because what we are seeing at the margin is a lot of the raw material which were hurting many of the segments right now. They are seeing moderation, and that should help. So I think overall, if I just go by even the first quarter results, I don't know, what I was sort of reading is that I think about 60-70% of the earnings are either in line or they have been better than the expectations. And I would in general go by the thesis that maybe we could see still about 15-17% kind of earnings growth for the year. So that's my assessment. But I think things are very fluid. We'll have to just look at the environment and maybe keep revising the estimates if there are any big changes which takes place.
Okay, Vineet, I wanted your thoughts on what's happening with the banks, because even today the bank Nifty is down almost 200 points, right? And we're not even in the first 10 minutes of trade. What's going on here? Do you believe that the worst, or rather the best of the bank's margin performance is behind us? Is there going to be margin moderation from here? And if yes, what do you do with the banks that you hold in the portfolio?
I think you're right, Sonia. I think most of the worries is around the fact that we have seen the peak margins. And I think after the bank's outperformance, maybe there is some bit of that consolidation at the current level. People may want to watch how the interest rates really move and what kind of bearing it has on the margins. But we have done a lot of our own sensitivity analysis around the banks. There are 3-4 things which still keeps us positive on the banks. One, even if we see the margins have peaked out, and maybe we may see some bit of margin corrections if the interest rates were to start going south. But more importantly, I think the credit environment is still pretty good. I would say there are competitive pressures and all of those. We are listening to that. But I would still say the banks, the large ones definitely are getting their share of the growth. And the credit quality in the system is still okay. And we won't come to know till the time the credit quality actually starts getting affected. But I think at the moment, there are no signals which are telling us that. And third and most important aspect has been the valuations are still maybe okay, considering the fact that some of these are more fundamental and more positive to the banking sector. So as far as we are concerned, we are not taking any different stance than what we had. We continue to own in a lot of our portfolios. Banking is an overweight segment, so that continues. We've not taken any different stance as of now.
Okay, what about something like autos? I'm asking because after a 3 or 5 year lull, the auto sector is coming back in a big way, right? Especially some of these players in the CV sector. I mean, Ashok Leyland is at a fresh 52-week high today. So which are the pockets where you still see valuation and growth headroom?
Like I've been actually highlighting that auto has been one of our sectors which, we favor at the moment, because like you mentioned, I think we are coming out of a low cycle and we'll see the next 2-3 years of good cycle. Now, which pockets to sort of focus on is something, we have to keep also looking at the valuations and maybe keep rebalancing our portfolios. But more importantly, where we have, felt, let's say, a bit of more comfort is owning auto ancillaries to play the auto sector revival, because there you are not really worried about any specific cycle going up or down, and you're broad basing the growth overall. And also, the other thing which, if one has to really maybe explore an option. Two-wheeler as a category has not done well. They are still lying low as compared to their 2019 highs. And maybe with the rural revival, which one is sort of anticipating with maybe election-led spending, or rural in itself doing well with the agro food prices doing well, maybe that's one segment which still gives you margin of safety. There could be one can sort of think of exploring that area as well.
Hi Vineet, good morning. Vineet, what about the FMCG pack and in particular ITC? They were making the right sound bites and now some action as well. I don't know whether it's fallen short of what the street expected with regard to their hotels business. But what's your view out there? I think you'll hold it in the portfolio.
So I think there are one can't really correlate ITC with purely FMCG, but I think there are comparables when one looks at the smaller piece of business which that owns. But without getting into a lot of details specific about ITC, we are continuing to own that. In general, I think FMCG we have an underweight stance. But as I said, I think as we look at the rural economics or the rural economy, starting to do well, maybe, and also what I was talking about, the raw material price pressures sort of moderating. I think those could be the positive factor for FMCG. Just that the valuations is something which basically keeps us away from the sector. But I think incrementally we are sort of exploring the few options there. In a few of our portfolios, we have mid-cap FMCG plays as well. So I think overall, that maybe the next 2 quarters could be interesting from the FMCG's perspective as well.
Got it. By the way, have you, this companies like PB Fintech and Zomato, etc., where there is a fair bit of focus on profitability now? Do you own anything there? And any thoughts? Because stocks have also run up, though. I mean, some would say a little too much. I mean, we had Suresh Ganapathy of Macquarie put out a note on PB Fintech saying, there is markets are valuing it very richly. Any thoughts at all?
So I think Prashant, still maybe there's some more time. We need to sort of give them some more time to see how they really, showcase profitability, what kind of visibility they are able to provide. I believe the environment is still challenging, and also if you see as an option, there are multiple good options to play where there are already established businesses which are really doing well. And one is not starved in terms of ideas as of now. I mean, evaluations, as I can say, is something which one has to be careful about. But in general, I think we have tried to sort of, stay with some of these established ones, and maybe some of these new areas where they are talking of profitability. That is a good point, but we need to watch them. The environment is pretty fluid as of now, so I think maybe give them some more time and before we take a call into some of these things.
Okay, we'll let you go on that note. And one sector that we spoke about, autos and auto ancillaries, that's on our radar right now. Thanks a lot for joining us. We have Bharat Forge, which is at a fresh 52-week high after reporting a solid set of Q1 FY24 earnings. The